This morning's inflation reading that measures what you're actually paying for goods did come in hot, but the market mostly shrugged it off because all eyes are on the weekend talks that are supposed to happen between the US and Iran and Pakistan. And usually, inflation drives mortgage rates much more than this and really would have been worse for us. CPI was actually the highest reading we've seen in 2 years, and that was driven almost entirely by a 21% jump in gas prices. That's a result of the closure in the Strait of Hormuz. But an important thing to note is that core CPI, which actually strips out that food and energy price, that came in below estimates. And the bond market took the headline number in stride, and maybe that was because the higher number was expected, as I warned about in the last report. Everyone knew that oil prices would show up in this report, but the question that the market is really asking is how long this inflation is going to stay elevated and what's going to happen in Iran, and how quickly we could see oil prices come down and stay lower. WTI is already back down to about $90, at least as of this morning, and PCE for February did also come out this week, and it was pretty much as expected. But that really is old news because it came from what happened before the Iran conflict, so it really didn't tell us much or really matter. But it did show that incomes are falling slightly and spending's holding up, even though the savings rate is near its lowest level since 2022. People are spending, what they have, but it's not sustainable, especially if oil prices stay high and discretionary income keeps getting squeezed. GDP for the fourth quarter was revised down again, and the economy was already slowing before any of the oil situation started. On the ceasefire front, the US and Iran did reach the 2-week agreement earlier this week, which gave us a bit of a break, and the markets did show some relief off of that, but it didn't really last too long, and we saw a lot of changes. A lot of oil tankers still aren't getting through. They were trying to charge tolls on ships, and there was accusations of violations of the ceasefire almost immediately. Negotiations between J.D. Vance, among other U.S. reps, as well as with Iranian representatives, I should say, are going to begin this weekend. That'll again happen in Pakistan. But Barry Habib thinks that we're going to get favorable news. I'm not personally holding my breath. We have seen a lot of action and escalations over the last couple weekends, and that includes, Trump's aggressive social posts. But the strait is still effectively closed, so we're only really seeing like 5 oil tankers per day crossing right now. And then totally separate, but Kevin Warsh's confirmation as the Fed chair has been delayed, and that's due to basically financial disclosures that still need to get submitted, but that transition is still going to happen. And just a couple things related to housing that are worth sharing with clients. I saw a recent survey found that 1 in 3 homeowners with a rate below 6% say they won't sell at any price. And among those, people with rates below 3%, that number rises to 52%. So that rate lock-in effect is a big part of why inventory is staying, really tight, especially here in San Diego. And I did see something else, that office to apartment conversions hit another record. Over 90,000 units are under construction across the nation. New York, D.C., and Chicago's where most of that is happening. And it's not going to solve the inventory problem overnight, but it is at least moving in the right direction. Next week's going to be driven again almost entirely by what comes out of Pakistan talks related to Iran. A real breakthrough on the strait would, of course, change the rate picture quickly. And I'll see you next Friday to let you know what happens.